Because sometimes the obvious needs to be said out loud. Who, in their right mind, is panic selling silver just because it pulled back a few dollars from the highs? Seriously, if you watched silver flirt with the mid-80s pullback, and your first instinct was to smash the sell button, then we need to have a real conversation. Not a motivational speech, not a hype rant, a grounded adult discussion about how markets actually behave when something big is unfolding. For days now, the narrative has been the same. It's overbought. RSI is stretched. It has to correct. And then when it does, what markets always do, briefly retrace to vacuum up liquidity, people act shocked, as if they've never seen this movie before. A dip from the 80s back toward the high 70s is not a collapse. It's a breath. It's the market clearing its throat before continuing the speech. And what happened next? January 6th, New York session, silver marched right back to $80. Not weeks later, not months later, immediately. The so-called correction barely had time to unpack its bags before it was shown the door. That wasn't weakness. That was confirmation. The market did exactly what it needed to do, and then it moved on. Before we go further, you need to understand where I'm coming from. I didn't learn markets from a YouTube thumbnail or a weekend course. I grew up around real capital, real risk, real consequences. My father was a top-tier trader in the United States, the kind of guy who didn't react to price, he influenced it. My mother comes from Hong Kong, where strategy isn't measured in quarters but in decades. That blend matters. Western urgency combined with Eastern patience gives you a very different lens on how power and money actually move. When you've watched this long enough, patterns stop feeling mysterious and start feeling repetitive. Human behavior in markets is painfully predictable. First comes excitement, then fear, then panic, then regret. The playbook never changes. You scare the crowd, you shake them out, and while they're dumping assets in a frenzy, someone on the other side is calmly accumulating. Not because they're smarter emotionally, but because they're positioned structurally. People love to say, an asset can't go up forever without correcting. That sounds intelligent. It feels responsible. It's also not a law of physics. Markets don't correct because an indicator says they should. They correct when supply overwhelms demand, and when demand is being driven by entities with virtually unlimited capital and long-term objectives. Technical levels become suggestions, not rules. If the dominant players decide price needs to move higher, it moves higher, full stop. No committee vote, no apology. And this moment isn't just about silver. Silver is the symptom. The real story is monetary. Waged for decades deep into a system that was fundamentally altered in 1971 when the dollar was severed from gold. Since then, everything has been built on confidence, on leverage, and the assumption that tomorrow will look close enough to today that no one asks too many questions. That assumption is now under stress. Fiat currencies don't fail overnight. They decay slowly, then suddenly. Purchasing power erodes quietly until one day people realize that numbers on a screen on 8T represent security. Hard assets do. This isn't ideology, it's history. Every reserve currency eventually meets this fate. The only debate is timing. While much of the Western world reacts to each CPI print and Fed press conference like it as a plot twist, other players think very differently. China, in particular, has been preparing for a monetary transition for years. Not reacting, preparing. They think in generations, not news cycles. They don't chase narratives, they execute plans. And part of that plan has been the steady accumulation of tangible assets, especially precious metals. Not paper contracts, physical metal. Quietly, methodically, relentlessly. This isn't speculation, it's insurance. It is positioning for a world where the dollar is no longer the unquestioned center of global trade. Now bring this back to what we just witnessed in price. Over the past several days, silver dipped below $77. Social media lit up with despair. People who were euphoric at $82 suddenly knew the bull market was over. Reddit threads filled with regret and second-guessing. And while all of that emotional selling was happening, the buyers of last resort stepped in. When you see sharp, fast dips that are immediately bought, that's not random. That's liquidity being harvested. Stops get triggered, leverage gets flushed, weak hands are removed. And the metal changes ownership from impatient traders to institutions that don't care about your entry price or your feelings. This wasn't a collapse in fundamentals. It was a transfer. Now we're back above $80 and suddenly the panic has gone quiet. Funny how that works. The next obvious level is $84. The same zone everyone celebrated and then feared just days ago. But here's the difference. When that level breaks again, the positioning underneath it is cleaner. Shorts are more nervous. Sellers are lighter. The fuel is there, and when short positions are forced to cover, that buying pressure doesn't ask for permission. It accelerates price. That's how you go from $84 to $100 faster than people think is reasonable. And from there, psychology shifts. Triple-digit silver stops sounding absurd and starts sounding inevitable. People ask, How can I buy at $80? Silver has never been this high. That's a lazy comparison. Adjust for inflation, adjust for currency debasement, adjust for a world drowning in debt and geopolitical tension. In real terms, silver is nowhere near expensive. What's expensive is pretending the dollar of 2026 has the same meaning as the dollar of 2000. Housing doubled, food nearly doubled, energy exploded. But silver at $80 is where people draw the line. That's not analysis. That's anchoring bias. What's coming is not a single event. It's a repricing, a slow then fast adjustment of what money means. When that shift accelerates, metals don T rise because they were suddenly more valuable. They rise because the measuring stick is shrinking. Will silver go straight up forever? No market does. But the idea that this move ends here, that this was the top, requires believing that debt no longer matters, that geopolitics are stabilizing, and that confidence in fiat systems is somehow being restored. That's a bold bet. Silver isn't just a trade, it's a reflection of stress in the system, and that stress isn't easing. So no, this wasn't the end. It wasn't even close. It was a pause, a shakeout, a reminder that markets reward patience and punish emotional certainty. If you understand who's buying, why they're buying, and how long they're willing to wait, the noise becomes almost entertaining. At this stage, the only real risk is confusing short-term discomfort with long-term failure. History isn't subtle about how these cycles end. The only mystery is who has the discipline to stay positioned when it matters. While most people were distracted by holiday sales, half-empty parking lots, and debates over whether Die Hard is a Christmas movie, something far more consequential was happening behind closed doors. In mid-December 2025, quietly and without any media fanfare, the United States Department of Defense signed off on a deal that tells you everything you need to know about where the silver market and the global power structure is heading next. This wasn't a symbolic announcement or a feel-good policy initiative. It was a $7.4 billion commitment to build a massive critical minerals processing facility in Clarksville, Tennessee, alongside Korea Zinc. Let that number sink in. $7.4 billion. That's not a pilot program. That's not Washington studying the issue. That's a full-scale admission that something has gone very wrong with the existing system. Here, S, the part that should make you pause. This will be the first major non-ferrous metal smelter built on U.S. soil since the 1970s. For over half a century, the United States was perfectly comfortable outsourcing the most critical part of the metal supply chain. We mined, or bought from allies, shipped concentrates overseas, mostly to China, let them do the refining, then bought back finished products at a premium. Efficient on paper, convenient in peacetime, a nightmare in a world that's fragmenting by the day. So why reverse course now? Why spend billions to bring processing home in the middle of what many still insist is just another commodity cycle? Because the supply chain isn't bending anymore, it's snapping. Chinese export controls that went into effect on January 1st didn't just rattle markets, they exposed a vulnerability that defense planners can't afford to ignore. Without access to refined metals, particularly silver, the U.S. military doesn't just lose efficiency, it loses capability. Silver isn't a nice-to-have, it's embedded in guidance systems, communications hardware, radar, satellites, fighter jets, and missiles. No silver, no modern military. And the Pentagon knows this. Now here's where the story gets genuinely interesting. The Department of Defense isn't just funding the project. It's taking a 40% equity stake. That's ownership. That means the metals coming out of this facility aren't destined for the open market. They're not heading to COMEX warehouses. They're not there to provide liquidity for bullion banks. They're going straight into strategic stockpiles. In plain English, the U.S. government just admitted, without saying a word, that silver is too important to be left to the free market. When governments start vertically integrating supply chains, that's not confidence. That's concern. This is resource nationalism, and it always shows up when shortages stop being theoretical and start becoming operational risks. The facility itself is designed to process 1.1 million tons of raw material per year, producing 13 different non-ferrous metals. 11 of those are classified as critical minerals by the U.S. Geological Survey. Silver sits near the top of that list. This wasn't a casual decision. This was the result of someone in December looking at inventories, looking at Chinese export policy, watching the Shanghai premium blow out, and realizing the cupboard was a lot emptier than advertised. Without silver, there are no Tomahawks, no F-35s, no next-generation satellite constellations. You can't PowerPoint your way around that reality. And then comes the plot twist. The financial institution structuring and financing this entire deal is J.P. Morgan. Yes, that J.P. Morgan. The same bank that has been the largest short in the silver market for well over a decade. The same institution fined for spoofing, manipulation, and coordinated suppression in futures markets. The same entity many retail investors love to blame for every downtick. So why would the biggest short and suddenly help build the biggest piece of physical infrastructure in 50 years? Because they can read a room. Paper markets work beautifully when supply is abundant and confidence is high. They fall apart when physical shortages emerge and delivery matters more than leverage. Holding massive short exposure in a world where governments are locking up supply is not a strategy. It's a liability. JP Morgan isn't abandoning the game. They're changing how it's played. Instead of pushing paper, they're positioning themselves to control flow, financing physical processing, sitting between Latin American mines and U.S. military demand, becoming the gatekeeper instead of the gambler. Actions speak louder than press releases, and this action screams that the paper era is on borrowed time. This smelter is purpose-built to handle concentrates from Mexico, Peru, Bolivia, and potentially even post-conflict Venezuela. Historically, that silver would have gone straight to China for refining. Now, that loop is being severed. Latin America to Tennessee to Pentagon stockpiles, closed circuit, minimal leakage. And JP Morgan earns on every ounce that moves through the system. That alone should recalibrate how you think about silver's role going forward. Now, zoom out to the pricing reality. In New York, comics would like you to believe silver is comfortably priced around $80. In Shanghai, the story is very different. As of the most recent Asian close, silver on the Shanghai Futures Exchange traded at roughly 18,120 yuan per kilogram. Convert that properly, accounting for exchange rates and unit differences, and you'd be looking at about 82 per ounce. $2 may not sound dramatic, but in commodities, persistent spreads are everything. This isn't a temporary glitch. It's a signal. There are now effectively two prices for silver: the paper price in the West and the physical necessity price in the East. Shanghai doesn't care about your RSI. Factories don't hedge production with hope. They need metal, and they're willing to pay up for it. That premium is acting like a vacuum, pulling physical silver out of Western vaults as arbitrage traders buy in New York and ship east for an instant profit. For decades, New York and London dictated global prices. Today, Shanghai is politely ignoring them. That's why silver pushed back above 80. The paper price isn't tea-leading anymore. It is being dragged higher by physical reality. Every ounce removed tightens inventories. Every uptick forces shorts closer to the edge. Every forced cover adds fuel to the move. Something eventually breaks. Either the exchange admits it can't deliver, shorts capitulate en masse, or China voluntarily steps aside. One of those scenarios is extremely unlikely. China has the reserves, the strategy, and the incentive to keep buying. Shorts are already deep underwater, and registered COMEX inventories are hovering around 30 million ounces, draining at an alarming pace. Do the math. At current drawdown rates, inventories hit zero before the end of January. That gives us weeks, not months. When pressure peaks, volatility will spike. Expect violent daily moves, margin hikes, trading halts, and every mechanism designed to discourage participation. None of that changes the underlying issue. This isn't about chart patterns. It's about nations securing strategic materials ahead of a monetary and geopolitical realignment. When governments start acting like this, prices don't politely drift sideways. They adjust, often abruptly. The only question is whether you're focused on the noise or paying attention to what the biggest players are actually doing. Let me be very clear about this, because clarity matters when volatility is high and emotions are loud. This is not the moment to flinch. This is not the moment to second-guess yourself because a chart blinked red for a few hours. This is the moment to understand what kind of environment you're in and act accordingly. When price pulls back in a structurally tight market, that's not a warning sign. That's an invitation. Every dip is an opportunity to accumulate something that the most powerful institutions on the planet are actively trying to secure for themselves. Not trade, secure. China is not playing the same game as retail traders. They are not watching 5-minute candles. They are not adjusting positions because an oscillator looks stretched. They are executing a long-range strategy that spans decades, not quarters. Every single day, billions in capital are deployed into hard assets, particularly silver, because they understand a basic truth. In a world with unlimited fiat currency and limited real resources, paper loses and physical wins. This isn't theory anymore. It's observable reality. It is 2026. The so-called Great Reset isn't yet some abstract future event that might happen one day. It's unfolding in real time. The debt levels are mathematically unpayable. The derivatives exposure is absurd. Confidence is the only thing holding the system together, and confidence is not a renewable resource. When that confidence cracks, what survives are assets without counterparty risk. Not promises, not IOUs, not digits on a screen. Real things. Things you can hold, store, and transfer without permission. And silver sits right at the center of that conversation. Not because it's shiny, but because it's indispensable. Silver is embedded in nearly every major growth trend of the 21st century. Solar energy doesn't function without it. Electric vehicles rely on it. Advanced electronics, medical equipment, 5G infrastructure, military hardware, aerospace systems, all silver dependent. At the same time, global mine supply is stagnating while demand continues to rise. We are consuming hundreds of millions of ounces more per year than we produce, and that deficit isn't shrinking. It's growing. Against that backdrop, arguing that silver is expensive at $80 is like arguing beachfront property is overpriced right before the bridge washes out. It misses the point entirely. Price is relative to the unit you're measuring against, and that unit, the dollar, is losing purchasing power faster than most people are willing to admit. Future generations are not going to ask why silver was $80 in 2026. They were going to ask why anyone sold it. People love to anchor to the past. They say, I'll wait for $75, or I need confirmation, or my personal favorite, I'm waiting for the RSI to cool off. Meanwhile, inventory disappears, premiums rise, and availability tightens. The market doesn't ring a bell when the opportunity window closes. It just quietly shuts. Now let's talk about what the near-term structure looks like, because understanding the path helps you stay rational during the noise. Silver has reclaimed the $80 level in the New York session. That matters. Over the next several days, it's entirely reasonable to see consolidation between roughly $78 and $80 that guess where weak hands exit and stronger hands accumulate. That's how markets transfer ownership before a larger move. Then comes the key level, $84. That level isn't just psychological, it's structural. A decisive daily close above it changes everything. Trend-following algorithms flip, risk models adjust. Funds that were stubbornly short are forced to reassess. Retail traders who sold lower rush back in, chasing price. Buying pressure begins to overwhelm selling pressure in a way that feels sudden but is actually mechanical. Once that door opens, moves that once took months can happen in days. The jump from $84 to $100 is not a multi-year journey. In a supply-constrained market with heavy short exposure, it can happen shockingly fast. From there, momentum feeds on itself. Short covering accelerates, liquidity thins, volatility expands. At that point, price targets start sounding ridiculous right up until they're printed on the screen. Could silver reach $120 shortly after breaking $100? Absolutely. Could $150 be in play within months? It's not outlandish. And if systemic stress escalates, whether through exchange delivery failures, geopolitical conflict, or a confidence event in fiat markets, prices north of $300 are no longer fantasy scenarios. They're contingency outcomes. But here's the part most people miss. The exact price is secondary. What matters is ounces. When monetary systems restructure, it's not about how many currency units you hold. It's about what those units can command. History is painfully consistent on this point. Paper wealth evaporates. Real assets endure. Land, energy, food, metals. These are the things that carry purchasing power through resets, reforms, and reboots. If all your exposure is tied to paper instruments, ETFs, unallocated accounts, derivatives, you're relying on counterparties remaining solvent and cooperative during a period when stress is rising. That's not a conservative posture. That's a hopeful one. Physical ownership changes the equation. Allocated metal with clear legal title removes layers of risk that most people don't think about until it's too late. When delivery matters, when exchanges wobble, when rules get rewritten, possession stops being a cliche and starts being a strategy. So the approach is straightforward. If you don't own physical silver, acquire it while you still can without extraordinary friction. Don't wait for a perfect entry that may never arrive. Don't wait for approval from analysts whose incentives are misaligned with your outcome. Accept that premiums exist for a reason. Accept that delivery times are a signal, not a flaw. If you already hold silver, hold it through volatility. Price swings are not a verdict on the thesis. They're part of the process. Watch the $84 level closely, because that's where the next phase likely begins. If you have additional capital and the market confirms strength, consider adding. If you don't, simply maintain your position and resist the urge to trade yourself out of a structurally sound setup. Ignore the commentary that insists silver is overbought. It was supposedly overbought at $30, at $50, at $70. The same voices will say it at $100 and beyond. They're not malicious. They're just operating with outdated frameworks in a changing world. And understand this, you are not early, but you are not late either. You are simply paying attention. The most powerful entities on Earth are accumulating physical silver. Governments, militaries, financial institutions that see where the constraints are forming. They are not doing this for entertainment. They are doing it because the rules of the game are changing. You're playing the same game, just with smaller numbers. The mechanics are identical. Accumulate real assets, hold through engineered volatility, let scarcity do the work. The system may be rigged, but it's not random. Once you understand the incentives, the behavior becomes predictable. Physical beats paper, real beats synthetic, scarcity beats leverage. Silver sits at the intersection of all three. The pullback from the mid-80s to the high 70s wasn't a failure. It was a liquidity sweep. It served its purpose. That chapter is closed. Price has reclaimed $80, and the structure underneath is stronger than before. What comes next is not a rerun, it's an escalation. So the decision isn't really about charts or forecasts, it's about whether you react to fear or act on understanding. Whether you hand over real assets for paper promises, or whether you recognize which side of that trade history is always rewarded. The window doesn't close with a countdown. It closes quietly, while most people are still waiting for certainty. You've been given the information, you've seen the signals. What you do with it is up to you.